Still hear a lot of commentary about a short, shallow recession. I think that's still the base case for a lot of investors. If that's your operating assumption, you probably don't really need to go beyond a typical recession in the drawdown peak to trough.
Right. So the, let's say, median historical recession S&P 500 loss is 27% or something like that?
27%, and that takes you to 3,501.
Right.
And we said, if 3,500 fails, you look to 3,200. That's an average recession. That's a 32% drop, so 32% to 3,200. And that would sort of be the next battleground. And interestingly, some of my friends in the technical strategy community have also been talking about 3,500 and 3,200 as support levels. So it all kind of adds up.
That is interesting how it does connect. 3,500, I guess, would be half of the entire kind of COVID low to the ultimate peak would be given up, and then some other reasons for 3,200 I have heard as well. It's nice when things like that happen. Do you think that that sort of soft consensus that you cite, that it's going to be a brief and shallow recession, is plausible? Is that your operating assumption?
I think it's still plausible. I think that it's, maybe a little early to say that is definitely 100% going to happen. I tell clients that I think a lot of it depends on the corporate reaction function between now and year end. And so one of the things that is different this time is the tightness of the labor market. Now, we know it's not going to stay incredibly tight forever. We know that these metrics are going to deteriorate, but the question is how much. If there's a massive wave of layoffs coming that happens, say, in the December-January timeframe, that might change the trajectory. But for now, we don't think that's going to happen. We think there is going to be some deterioration, but not something really of a major scale.
When we got the very strong rally off the June lows in the S&P 500, it carried up about 18%. There were lots of good technical characteristics of that initial rally, but also you were able to say, maybe we kind of overplayed the imminent recession card into the June lows. At the same time, you could have built a case that the Fed was getting closer to where it had to go, and there might, in fact, be a pivot priced into the forward curve. Fed didn't like that, it seems. Plus, inflation didn't calm down as much as we would prefer. Are we in for another round of that kind of false hope, or is there some more grounding to it now?
So, look, I think that hope is still alive. As I've talked to investors, I don't think anybody's pounding the table saying the Fed is definitely going to pivot. I know some of the headlines suggest that. That's not really what I'm hearing. But I do get a lot of questions about, what are the components of inflation doing? There are still people poking around, looking at things, saying the case for moderation is here. And, I think that the Fed is talking a very tough game and investors are listening, but I think a lot of investors I speak with say, well, look, if inflation is moderating and employment's deteriorating, sort of what's the point of keeping this aggressive stance? So I had one client put it to me and say, maybe the Fed is bluffing in here. And, I think there's a lot of uncertainty around that, but that conversation is still going on.
If not bluffing, then perhaps the Fed is just saying, we think there's a certain amount we can get done. We're going to see what the economy and the market allows us to get done in terms of higher rates. And I guess in any case, we're a few months closer to wherever we're ending up than we were in June.
And I'll tell you, in a strange way, I actually kind of like that the market broke the June lows, because one of the things I was struggling with over the summer in conversations with investors, it just seemed like it was a little too early in June for markets to bottom. If you go back to the 30s, markets typically bottom about 3 to 6 months. I think it's about 4.5 on average before a recession is over. So if you think this recession is happening 4Q and 1Q, June was just too early to be the bottom, but having it sometime in coming months is plausible.
Now, you have also been looking at the template of the kind of 2001 to 2003 period, I guess, when you did have, multiple waves of selling in new lows and bear market rallies. And I guess you would say not a very deep recession alongside that. Where does that map take us now? It's
fascinating because we actually looked at the 2002-2003 period and the 2010-2011 period because we sort of described those as normalization. You had kind of a triple bottom. You had the big crisis, initial rally, and then you sort of got stuck in a rut for a while. And we're actually trading this year with a 72% correlation with 02. So it's more like 02 than it was like 2010-2011. That playbook says, if it happens, that you should bottom sometime in early October, that you should move up maybe 20% or so into November, but then give it all right back and go down and retest the low by next March. And look, that kind of makes sense to me, Mike, because I think there's some excitement building over the midterms again. 2002 was also a midterm election year. And if you think about earnings, I do think investors, before they're really going to be true bargain hunters, they need some certainty on the E. I don't think we're going to get anything close to certainty on the earnings outlook until that kind of March timeframe, once companies have reported 4Q and put those 2023 outlooks out and analysts have finally done sort of the cleanup on their numbers.
Yeah, I guess in the meantime, if in fact you have this period of relief or where some of the pressure gets taken off of stocks, where's the opportunity? Where should you consider still to be risky?
So I think it's a question of sort of what your time horizon is. I think one area that's been very de-risked, remember, I'm an old small cap strategist.
Sure.
I think the small caps have clearly priced in a recession at this point in time. They're trading like ISM Manufacturing has already plunged to typical troughs. They're baking in a very big spike in jobless claims beyond the uptick we've already seen, and valuations have been at trough levels. And if you look at the performance, they've been trading sideways relative to large caps since January. We've seen some good days and bad days recently, but they really haven't broken out of that range. So I've described small caps as the lion that's waiting to pounce. It hasn't broken out yet, but the stability in and of itself in that relative trade this year is telling you something important.
Interesting.